You want to have your money work for you? What you need to do is take back control of your money first. And you can make all the money instead of them making all the money. This isn't something that only works for some and not others. This works for every one of you. You're still making interest and dividends compounding on the full amount. Cost is only an issue in the absence of value. I'm trying to teach you how to be the bank. This is definitely what the wealthy do with money. All right, what's going on, everybody? It's another week, another wealth webinar. And today I thought, in light of the Indy 500 just having happened this weekend, which I was fortunate enough to be there, we talk a little bit about cars. You know, all of you or most of you have probably seen the video teaching you how to get all the money back for every car you're ever going to buy, drive, and own. What I want to do today is I want to show all of you what it's like and how it is that we can get all the money back for every single car we will ever buy, drive, and own. But it's not just cars, it's planes, it's copy machines, it's boats. Some of you mentioned you were out on the boats for this holiday weekend. It doesn't matter what it is. Any large purchase that you might make, I could show you how to get all the money back for it. And I want to show you just the sequence. It's an old video that I did, and I probably should update it. We're not going to play the video, but I'm going to walk you through step by step, because there's something really interesting that we don't often talk about, and we should talk about it a lot more, is the value of time. Everybody I know is typically in a big rush to make a lot of money, and I understand that. So we can show you how to make money quickly, but the best way to make money is over the long haul. And the best thing about making money over the long haul is as you continue to make money, your money compounds and continues to compound with what we're going to talk about today. In this webinar, we've got about an hour and 20 minutes. Okay, that's the runtime we've got. Some of you would agree that that's a lot of time, and some of you would agree that that's not enough time. Now, I'm going to tell you from my standpoint, that's not enough time. It's enough time to cover maybe one particular topic, which we're going to focus on: cars. We're going to show you how to get all the money back for all the cars you're going to buy, drive, and own, but we're going to talk about 3 different cars. And I'm going to talk about 2 different strategies. Okay, I'm going to talk to you the normal strategy, and I'm going to show you a whole different strategy that we have basically implemented and also taught, but very few of you have seen it, because in order to have seen it, you would have had to join us for the last 3-day Money School Essentials training, which, you know, some of you have already signed up for. How many of you have already signed up for Money School 3-day training this coming weekend, Friday, Saturday, Sunday? There we go. Andy's already signed up. I saw Andy. Thanks, buddy. Andy's been to a couple, if I'm not mistaken. Tess has been to all of them. She won't make this one, though. I just found this out today. Tess will not be at this one because she'll be at a mastermind going on by our buddy. All right, we got Rhonda, we got Jordy coming. Awesome. So congratulations to each of you, because you jumped on an opportunity at one of our previews that we did, and you got your tickets for this weekend's 3-day training, and you also got some really cool gifts. Well, today will be the last day where any of you can sign up for the 3-day training and get a very unique gift. And I like things that nobody else has. How many of you like things that nobody else has, right? If you owned a car that you had the only one of them ever, like you had the original Batmobile, right? Or you had the original Dukes of Hazzard car, it'd be worth a lot of money, and everybody would want it because it's rare. Well, we created rare things just for the 3-day trainings. We created a shirt or a hat that is a one-of-a-kind, that the only way you'll be able to get it is by joining us for the 3-day training. And you will be the only one, well, you and anyone else on this training today will be the only ones who will have this particular design, which we'll show you in a little bit. The other cool thing about what I'm going to show you with cars is it only involves changing just one thing. That's right. You hear me say this all the time. Change one thing, and that's where your money goes first. That's the only change you need to make. And then you need to follow a process. It's not a product. There's not some magic product like there is pills. You know, they always say, oh, there's a magic pill. You'll lose 30 pounds. Guess what? You'll probably gain it all back on that magic pill. There's no magic product. There's only a product that makes your money work a little bit harder without you having to work any harder. How many of you would love for your money to work harder, but you don't have to work any harder? Any of you want that? You have to work no harder and have to take on 0 risk, but your money works harder for you, which means you get more, you can buy more, and you can enjoy more. Now, some of you were out on the boat this weekend. Some of you were, just with family this weekend. That is the ultimate freedom. That is the freedom of time. And that is something that the only way you can get the freedom of time is to have your money working for you. And that's really what we need to learn. And there's lots of things that we can talk about for making your money work for you. And this weekend, we'll cover all sorts of them, from private hedge funds, which maybe I'll give you a sampling of what that looks like, to all sorts of things, protection of your assets. How about not paying as much in taxes? Before we're done today, I'll just kind of give you a snippet of an idea how some of you could benefit with paying a lot less taxes just by participating in something that's in the tax code that's always been there since 1913, that very few people know about it and very few CPAs ever talk to their clients about it. It blows my mind. Let's just dive in. I've got a scenario here where there's 3 different cars, and you can see these are my cars that I bought. Now this is older. Like, I could go way further because this was a car that we bought for my wife, and since then there's been 4 additional cars that we have bought as a family. But these 3 really sum it up, and we'll really show you how this whole thing works, and it'll do a really, really good job of getting you to a point where you'll understand that. But this is super fun. This is something that I learned from the Money Tank event. There's one gentleman that came, he kind of did this, and I want to do a test. This is kind of a fill in the blank. So all I'm going to do is I'm going to read part of a sentence, and you're going to give the last word, the first thing that comes to your mind. You guys are going to put it up there, okay? Fair enough? Everybody got that? So when you were in school, your parents wanted you to get good what? Drew got it. Grades. Brad got it. Elsa got it. Mark got it. Perfect. When you were in college, your parents wanted you to get good. There we go. Again, grades, right? So we got grades and grades. Now this one's kind of pretty unique for some of you. But when your parents didn't want you living in the house or in the basement anymore, they told you you need to go out and make some what? That's right, money. So when your parents didn't want you in the basement anymore, they said, son or daughter, go out there and make some money. And when you heard that, you said to yourself, great, in order to make money, I need to get a job, right? I got to get a job. Now the final fill in the blanks, every one of you should have no problem with this. So remember, it was when you went to school, your parents wanted you to get good grades. When you went to college, your parents wanted you to get good grades. Then when your parents wanted you out of the house, they said, you got to go make some money. And then when you had to make some money, you had to get a job. Please tell me what job stands for. And you break all the words down, or all the letters down. What does job stand for? That's right. Just over broke. So we need to get good grades in school, good grades in college. We need to make some money by getting a job, but job stands for just over broke. Please tell me where the problem is there. Well, I think the biggest problem is we've just been taught the big lie. We've been taught that to make money, we got to go out and we got to work for it. We got to trade our hours for dollars. And trading your hours for dollars puts you in a vicious cycle. That means you need to actually work longer. You need to do overtime. I can't tell you how many times my dad would pick up overtime just so he got double time. You hear how I said that? He'd pick up overtime so he got double time. So if my dad made 10 bucks an hour, double time was 20 bucks an hour. But what did that cost him? Time. And what is time? The most valuable resource all of you have. So that's the lie we've all been taught, that we have to work harder to make more money to get the things we want. And then, you've watched Fight Club, and Tyler Durden said, well, what do? We work jobs we hate to buy things we don't even want or like to impress people we don't even like, something like that. But it's just all part of the same equation of the big lie we've been taught. And then what the wealthy have figured out is they figured out how to do the exact same thing they've always done, but by changing one thing, they've found out how to make their money work for them so that they don't have to work as much or at all. Because if your money's working for you, you don't have to work as much. And I'll show you how to do that as well. A lot of that is going to be happening in the 3-day because that's going to be a big focus. But the other problem when you start talking about your money working for you, a lot of you are also thinking that the only way your money can work for you is by putting it in the stock market. How's that working out for anyone right now? I haven't checked today, but I know this morning it was down. Did the debt ceiling crack? Oh yeah, down 200 points. So, all right, there you go. That's how it's working out today. But then there's always the people that are optimistic. Oh, it'll pop back up once they negotiate the debt ceiling. Yep, then it'll be the next thing and the next thing and the next thing. Folks, it's a roller coaster ride. And I'll show you what it looks like. So let's get into the cars, okay? So if there's 3 different cars that I bought This one, this $20,000 car was done in 2008. So I want you to just do the math. 2008, that was during the Great Recession, or actually I bought the car before the Great Recession kicked in, and that was 2008. So that was quite a while ago, right? The next car would have been right around 2013 or 14. And this final vehicle would have been, oh, how long ago would that have been? 4 years ago. So there's your time frame. 2008, 2013 or 14, and call that 2020. We'll just do that, give or take. So these are the three different vehicles that we're going to talk about today. The first car, and I'm just going to tell you right now, conventional financing. How many of you bought your car with a loan from a bank? Just put yes. A whole bunch of you that took a loan out from the bank. So if I were to have financed the first car with a loan from the bank, that $20,000, I could have got it. And remember, this is 2008. I could have got a 5-year loan at 5%. Very real. This was Cornerstone Community Credit Union. And I actually did take a loan out for this car, but I eventually became the bank and paid the loan off. At a $20,000 5-year loan at 5%, my payment was $416 a month, $5,000 a year, just rounded down. And the total interest over 5 years I would given up to the bank, $2,917. So any of you that have taken a loan out for your car, have you ever calculated how much interest you'll pay on that car? Probably not, right? You just know what the monthly payment is. But just do yourself a favor and just take a look at the interest and the principal and figure out how much interest are you paying to that bank or that finance company for that car. It's a good exercise to do because you'll start realizing how much money you're leaking just on cars. Okay, we're only talking about a $20,000 car here. The second car was about 13 or 14, give or take, 2013 or 14. It was a $45,000 car, which was a major stretch for me at that time. I'd never bought a car that was that much, but this was an S4 Avant, a really sweet one, which I'll show a picture of. So I went to the bank during this period. Now you'll remember this economic cycle was right after the Great Recession. So what did the Fed do after the Great Recession? They lowered interest rates close to zero, and then they came up a little bit. So I got this loan at 3%. I mean, some people would be like, that's a serious win to get a car loan at 3%. Okay, well, if that's a serious win, my payment was $875, $10,500 a year to buy this car. The total interest I paid was $3,806. Tell me how that's a win. Everybody just gets so caught up in the interest rate. You get so hung up on the 3% because it's less than the 5%. And today you probably can't get a car loan less than 7%, give or take. But we think that this is a win because it's 3%. But when you really do the math, $3,806 is given away to the bank over 5 years. That's not a win. Plus the car depreciates. And the final car right over here was a $63,000 Porsche Cayenne Hybrid S. 5-year loan at that time would have been 4.5%. Payment, $1,084 a month, $13,000 a year. Total interest that I would have given away would be $9,758. So let's just add the interest I would have given away. And this is just 3 cars. Okay, we're only talking about 3 cars. I'm going to buy way more than 3 cars in my lifetime, as all of you are. So if you all figure it out, most people buy a new car every 5 years. So just figure out, based on your life expectancy, take yourself to 90 years old, do yourself a favor, and 90 years old, and then just divide that out by, how long do you have? How long do you have, or how many cars are you going to buy if it was every 5 years? So the first car, I would have given away $2,917 in interest. The second car, $3,806 in interest. The third car, Larissa's Porsche, $9,758. That's $16,481. If everybody can just remember that. 3 cars at what most of you right now would say that these were pretty good interest rates. 5, 3, and 4.5. $16,481. That's how much money we would give away. All right, so what if all you had to do, folks, is change one thing, and this $16,000 would be in your bank account? I would pay myself $2,917 for that car. I'd pay myself $3,806 for that car, and I'd pay myself $99,758 for that car. So literally, like, by changing where your money goes first, and by adding this process I'm going to show you, what you can do is change the dynamic of who keeps the interest. In my scenario I'm about to show you, I kept the interest on every one of these cars. But you see, first I had to go through the math to figure out what I would have given away to somebody else. And I'll tell you why I do that. I figure this out on every vehicle I buy. Why? Because I want to know how much my monthly payment with interest should be back to my bank. Now, some of you that haven't seen the original video right now just don't fully understand what I'm talking about, but that's okay. I'm going to get to it. So here's the first thing I want to, before I get into the numbers on this one, okay, this is the first car. And if you can see this over here, it's even date stamped. So it was April 6th, 2008. And this vehicle, this is back when I lived in Lockport on Cherry Street. This is a Audi A8, okay? It was a used one. It had like 120,000 miles, but it was a nice car. This car, like I said, I bought it for 20 grand. How many of you have paid cash for your car? Anyone on here pay cash for your car? Elsa's the only one. Well, Mitchell did once. Freddie has. So it's interesting when I ask if anyone paid cash. William has. I've only ever paid cash. That's interesting because that's rare right there. Jimmy Davidson, first and only car I have ever bought. There we go. And Drew said I've only ever paid cash, which, okay, Larry. Okay, so now we're getting some cash people come out. But the traditional way that people buy cars right now is they finance cars with the bank or they lease a car. Very few of you are stealing cars because that's the fourth way you can buy a car. But for all of you that paid cash for a car, you all realized one thing: you had to save up for it. So I'm going to show the same thing. I had to save up to buy this car. So in this example, I was saving roughly $18,000 a year. Okay, so I was saving $18,000 a year, and that would have been the total amount I saved, $1,500 a month. Now, for some of you, that's a lot. For some of you, that's nothing. But back when I did this, that was a lot for me to save. And in a matter of fact, back then I was putting money into a 401k, and where the $1,500 came from to put into this, I still haven't told you what this is yet. It came from me stopping the money that I was putting into the mutual fund accounts at the financial firm I worked for. See, back then I was a financial advisor. And in 2008, a lot of the money that I saved, I had been putting it into mutual funds. ETFs didn't even exist back then, or if they did, we didn't even really talk about them. And not only that, I would put money in money market accounts, and I'd put money in 401k, and I'd put money into all the same places most of you have been taught to put money. But because it was 2008, and now we're getting to the point where we're after the Great Recession, I stopped putting any money in any mutual funds because I didn't want to lose any more money. Because at that point, the market was going down. Now, some of you would say, well, that was a mistake. You should have kept buying low, but I didn't. I was just scared. I was scared. During that recession, a lot of people were scared and they froze. But see, even though I was scared, I didn't freeze. I still saved money. I just changed where it went. So what this represents, okay, where my money was changed to, this is a specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends. Now, this particular policy was a New York Life policy. It's actually a combination of a couple. So there was two New York Life policies that made this up. It wasn't just one. To make it simple for the training, I just consolidated it. So I had two whole life policies from a mutually owned insurance company that paid dividends. And back then it was New York Life. We don't use New York Life today. They won't work as well for this, but I just want to tell you that back then I didn't know what I know today. But I did know that a safe place to put my money was a whole life insurance policy. I did know that it built cash value, and I did know that I could use that cash value if I needed it. So what did I do? I put $1,500 in, and I had been doing that across the board for a period of 3 years. Now, when I bought this car in 2008, I bought that car for 20 grand. Now, the truth of the matter is I didn't start saving in this in order to buy the car. I had just been putting money into these whole life policies, and that was it. So that's why I had started saving. So when I bought the car, I actually financed it through Cornerstone Federal Credit Union, which is how I knew the numbers. And when I financed it through the bank, I learned during this period of time about this process, the infinite banking concept. And what I basically did is I took a loan from my policy. Now you can see I put 18,000 in, I had 10,990 in the first year. I put 18,000 in the second year, I had 22,000. I put 18,000 in the third year, and I had 40,603. So all I did is I took a $20,000 loan from my policy, and I paid off Cornerstone Federal Credit Union. Everybody's tracking what I did. Nothing difficult here. I just took the money from my policy, I took the loan against it, and I paid off Cornerstone Federal Credit Union. Now, here's the first thing you all need to know. I started with $40,603 and I took $20,000 out to buy the car. How much money was still in my policy earning interest and dividends? Because New York Life paid interest and dividends just like all the companies we use today. Does anyone know? Do the math again. I had 40,603, but I took 20,000 out to pay off that car loan. That's right. Alex said all of it. I still have 40,603 in my policy earning interest. So where'd the 20 grand come from? The insurance company gave me 20,000 of my death benefit early, so I got to use my death benefit while I was living. And all the insurance company did is just use my 40,000 in cash value to collateralize the $20,000 loan. And they charged me interest on that loan. It was probably right around 4% back then. They were charging me 4% on the 20, but I'm earning probably pretty close to 6% on 40,000. So I'm earning 6% with dividend on 40, and I'm paying 4% on 20. What am I making in the middle? I'm making a spread. So the insurance company is paying me more than what they're charging me. Therefore, I make a spread. To further define that, when you go to a bank and you deposit money in the bank pays you interest on your money, right? Does the bank just put your money in the safe or in the vaults? No, they lend that money out. So let's just play a math experiment because I want you to understand how a traditional bank works. Remember, the bank was going to charge me or was charging me 5% for this AA. If you put money into the bank as a deposit and the bank pays you 2%, and then you take a loan out to buy this car and they charge you 5%, how much money did the bank make? They pay you 2%, they charge you 5%. The bank made 3%. Now, I changed where my money went that I used to save. I no longer put it in the traditional bank and I put it into a specially designed whole life. Remember, I took a $20,000 loan, which was the insurance company giving me part of my death benefit early, but they never touched any of my money. My money all stayed in there, all 40,603 earning interest and dividends. So hypothetically, let's say that my 40,603 back then was earning 6% with dividend, and the insurance company was charging me 4%. What is my gross spread? 2%. Now, is that the same thing that a bank does? Almost. So what I'm trying to explain to you is everything that we teach comes down to a simple philosophy. You want to have your money work for you? What you need to do is take back control of your money first. And that is by changing where your money goes first. Then once you take back control of it, then you add a process, you add a step. And that step is just treat your money the same way you treat the bank's money. I always like to say, take back control of your money and then learn how to become the bank. I literally just with one car here just showed you how to become the bank because we're doing almost the exact same thing a bank does. We're making a spread, and that's how banks make money. They make a spread. There's not a bank in this country that makes less than 400 to 1,300% more than you do. Not one. You could look that up in Bauer Financial. But now we're not done there. So all we did at this point is we paid off the car loan to the bank. But if you remember, I was making monthly payments to Cornerstone Federal Credit Union. So if I was making a payment to them and I want to become the bank, what's another rule I got to do? Don't steal from my bank. Because I wouldn't steal from Cornerstone. I would never, if I stop paying Cornerstone, they're going to repo my car. So if I don't want my car to get repoed by my bank, which is a specially designed whole life, I should make the same car payment I made to Cornerstone to my bank. I'm going to make that car payment, roughly $5,000 a year in car payments. And I'm going to pay that back to my bank. That's all I'm going to do. My bank is a specially designed whole life. So all I'm doing is every month I'm making a payment back to repay the loan that I took out. So if we add it all up, over 7 years, which is the time frame I'm showing for this first car, I put in $126,000. In car payments, I paid $25,000 in car payments. 5,000 times 5, 25,000. And I took a loan out for 20 grand to buy the car. So I would subtract 20,000 from that $151,000, right? So if we do it all over here, we can basically get the math. Total deposits and car loan payments, $151,000, less the purchase of the car, which was the repayment of that loan that I owed to Cornerstone, 20 grand. So my net deposit is $131,000. That's how much money I put into my banking system. Cash value growth after the purchase, 116,000 right here. My cash value grew to 116,343. So for this first car that I bought using my banking system, not their banking system, I got back 89 cents of every dollar that I paid for that car. But the best part is, folks, I'd still own the car. Free and clear. It's in the driveway. But I got 89 cents back of every dollar I paid. This is where it starts. What questions do you guys have for the first car? Because we're going to move on and I'm going to go faster. I'm doing this a little different than I normally do. Like I said, I got an hour and a half today, and I want to just cover a couple things because the rest of what we're going to cover is going to be covered in the 3-day training this weekend. But I want to give you some golden nuggets. Now, I didn't get all the money back, but I certainly got 89 cents back. Changed where my savings went, took the loan against the death benefit. The insurance company continued to pay me interest and dividends on the full amount, which means I made a spread just like the good old banks do. And then I treated my money the same way I treated the bank's money. And I made monthly car payments back to my policy as loan repayments. And at the end of it, well, I got 89 cents back for the first car.
Yeah, the only question, I don't know, maybe you're getting to this, but they said, what if a client doesn't want to buy the car cash? They want to lease the car for their business.
Okay. If you can hold that question, I would love to get back that one. I'd love to come back to that at the end because I'll just show you how you can get paid to drive company cars. Let me repeat that. How you can get paid to drive your company's car. So forget about leasing the car and doing all that stuff that you've been taught. What if I just show you how to do exactly what you said, lease a car, but how you get paid for doing that? Wouldn't that be better? Because I don't know anybody getting paid to drive the car at the company, right? But I'm going to show you how you can. But you got to first learn this, and then we'll come back to that at the end.
Excellent.
As you all know, we don't keep cars forever. That A8 was nice, but it did have 110 or 120,000 miles on it. So when my buddy Chris, I used to go to car shows, and he rolls up in this car. This is an S4. I can't remember the year, but probably around a 12 or 13. This is an Audi S4 Avant, slammed. It had a custom exhaust, custom wheels, painted calipers. It was a pretty sweet car for the time. And again, I know that this time frame of this car was around 2013 because this is that house that me and Larissa had to sell because I got into a really tough financial place around there. So Audi S4 Avant, slammed, pretty sweet car. Well, I'd asked this Chris guy if he wanted to sell his car, and he said, yeah, he actually was selling it, and he wanted $45,000 bucks. So remember, I had that A8. I sold that car. I didn't know anything on it. I just sold that car and I had the money. But all I did is somehow that money went somewhere. So here, this is year 8. I basically took a loan from my policy for $45,000 and I bought this car. I figured out what the monthly payment would have been for this car. Okay, it works out to be $10,500 per year. Remember, we went over this in the beginning. That's how much I would pay a bank at 3% because back then interest rates were low. And all I did is I took the loan against the cash value. So now remember, this is the 8th year. My cash value would have been, let's see, $148,001. I took 45 of that out, meaning that I have 103 left in cash value. But how much money is earning interest? That's right, $148,001. I took the loan at $45,000, and back then, again, interest rates are only 4%. They're slightly higher now, but interest rates were 4% from the insurance company. So this is kind of a weird thing, and I want to call this out. I could have gotten a loan from the bank at 3%, but the insurance company charged me 4%. Some of you would think of that and you would say, oh, well, why would you do that? If you could go to the bank and you could borrow the money at 3, why would you ever take a loan from the insurance company at 4? Can anyone answer that question before I go into explaining it? Why would I take a loan at 4% from the insurance company instead of going to the bank and taking a loan at 3%? Because most of you are thinking 3 is better than 4. It'd be better off taking a loan from the bank at 3%. Because again, like I told you, we've been taught to believe that sometimes the lower number is the better number. And sometimes it is, but not in this scenario. Okay, recap. So there we go. I like that answer, David. I'm making the spread. Absolutely correct. So I take 45 grand from my policy, which is the insurance company giving me a loan against my death benefit, using my money to collateralize it. My cash value is the collateral, but they charge me 4%. I know that I could have went to the bank and gotten a loan at 3%. So what did I do? I figured out how much a $45,000 loan at the bank, and I used Cornerstone. This was the same bank. I've almost financed all my cars through Cornerstone if I used a traditional bank. I could have gotten a loan at 3%. So I'm only going to charge myself the exact same amount that I would get charged through the credit union, and that's 3%. So this payment, which works out to be $10,500 a year, is at 3%. Pretty cool, huh? I'm just paying the same exact monthly payment that I would pay to the bank. But remember, the insurance company is charging me 4 and I'm making 6. But I'm making 6 on $148,000 and I'm paying 4. I'm still making a spread. That's just looking at the surface too. One thing we haven't shown you yet is I'm actually making a way bigger spread than just 2. I'm making a spread, but the reason I said my spread is more than 2, because some of you are probably still confused. If I'm making 6 dividends and interest and I'm paying 4, you're still thinking I'm making 2, but I'm not. I'm making a lot more than 2 because I'm making interest on the full 148. Okay. And my interest that I'm making, if I then divided the 18 into the growth that I made that year, my cash on cash return is far more than 2%. You see, here's the thing. And some of you already know this, but I'm just going to reiterate the facts. In this scenario, what we're dealing with is we're dealing with simple interest and compound interest. Those are the 2 factors we're dealing with. Interest rate, 10% per annum, simple interest, compound interest, 10,000. This is all I want to prove to you folks. Every year, you're compounding on a higher amount as represented here. So this would be simple interest, 10 grand. Compound interest would be 15. You made an extra $5,937 on 10 grand at 10%, because this year you're compounding on 11,000 and this 11,100. And you can basically kind of see how it works. It makes a massive difference. And the only reason I wanted to call this out is your policy, that specially designed and engineered whole life, works exactly the same way. I am 8 years into this process. 8 years, which means I've been compounding this cash value for 8 years. The other thing I've been doing is, just like this car, this S4, every month I'm paying the loan down. So not only does compound interest always beat simple interest, the simple interest car loan is decreasing. The balance is decreasing. So every single month I'm paying less simple interest because the principal balance is declining. You see, one's going down, the other's going up. That's why this is always going to work. It doesn't matter my opinion on it. It doesn't matter how great I tell you this is. It's simple mathematics. That's why this works. So let's dive back in, and I kind of just wanted to explain that. Now let's look at this whole thing from year 8 to 12. If I kept this car for 5 years, which, just for the record, I just want to be transparent, I did not keep this car that long. Okay, I get into financial trouble. I had to sell off the house. I had to sell off the car. I'm just being transparent, but I'm going to show this to you as if I never sold the car, because that's the only way I can illustrate it. So I kept making $18,000 yearly deposits, $1,500 a month. But by the time I got to the 11th year, I couldn't make $18,000 deposits into my specially designed whole life. I had to reduce it down to $7,200. So you can see I put less money in years 11 and 12. So the total amount of deposits I put in from year 8 to 12 is only $68,400. I repaid the car. So every single month, all I do is I set up a bill pay, just like I would if I was paying Cornerstone Credit Union. I make a bill pay, but I make the bill pay to the insurance company. And I call it a loan repayment, just like you would if you paid the traditional bank, the Cornerstone Bank, right? So I paid $52,500 interest plus principal on this car. $52,500 plus my deposits of $68,400. Total deposits in car loan payments, $120,900. Less the car, $45,000. So my net deposit on that car is $75,900. That's my total net injection into my banking system, which from here on out, I want you to think of your banking system as being a private bank that you set up for yourself, for your family. That's it. This is a private family banking system. That's what we're building here. So cash value growth after the purchase, and we can just look at the numbers, $116,718. That's net. My cash value growth after I bought the car was $116,718. So if we were to do the math, how much money did I get back for buying this car if I kept it for the full 5 years? $1.53 of every single dollar that I paid for this car. I literally got $1.53 of every dollar I paid for that car back. Remember, the first car was only 89 cents. And some of you were like, you said you were going to show me how to get all the money back. Did I not just get all the money back for both cars now? I did. It took a little bit more time, but I said that earlier. I said, I'm going to show you how to build wealth. It takes time. This is time. But $1.53 back for this car. And then I did sell the car. That's just the second car, folks. You see how this is going? So now if we were to go to the third car, And this is a cool story because this car actually really happened. And this car, I got to just tell you a story. It's a all blacked out Porsche Cayenne Hybrid S. Sweet car. I highly recommend this car. Although we ended up trading it in on a Maserati, stupid decision, but it was a great car. But I didn't just buy this car to buy a car. I bought this car for my wife. This is right after I was told by her that she was pregnant. This is when she got pregnant with Vivi. Okay, now Vivi's 3 years old, just to put things into perspective. And I remember her talking about a push gift. Push gift is where the husband, I guess we're supposed to give the wife, or the mother of our soon-to-be child a gift, because pushing a baby out is a lot of work. And indeed, I would sincerely agree. It's a lot of work and not something I'd like to ever have to do. Thankfully, being men, we don't really have to do that. Stephen, you didn't have to do that, did you?
No,
but you can respect that would be a lot of work.
Yes.
And worthy of a gift.
Absolutely.
All right. So that's the push gift. So this was her push gift. All right. It was a Porsche. And we went to the dealership, and I remember they didn't have it on the lot because it was just traded in. We only buy used cars. And when it was traded in, I remember the guy at the dealership told me about it. And I said, great. And we went back and forth negotiating the price, because that's just what you do. You always negotiate a price. He'd go back to the sales manager, come back, slide a piece of paper over with a monthly payment. I'd say no. He'd go back again. And we did this like 3 or 4 times. Finally, he came back with a piece of paper. He said, this is our final invest. We're losing money on this car. Or he said something like that. And he slid the number over, which was a monthly payment. And I said, yes, that's fine. And if you remember, this is like a $1,018 monthly payment for this car. That was the negotiation. I then pushed the stack of credit applications back to him when we said we'd take the car. And I said, I'm going to pay cash for the car. He was somewhat upset because he thought he was getting the deal, but he thought he was getting the financing too. Well, of course he thought he was getting the financing. If you remember, the financing charges on this were over $9,000 on this car. Let's go through the numbers here on this Porsche Cayenne that I bought. I was depositing $7,200 a year into my specially designed whole life. I bought the car for $63,000. Now, let me just do the math, because remember, I have now in the 13th year, I have $185,000 in my policy, but I actually have 185 plus 63,000. So I have $248,430 in my policies, because I'm going to preface, this is multiple policies now. This is not just one policy. And I actually think at this point, this might have even been like 3 or 4 policies. So I just added all the numbers together. And just so you all know, if you've watched any of my videos, my policies, some of those early New York life policies are just normal whole life policies. We don't design normal whole life policies, okay? And then some of the policies that we did are 60/40 Nelson Nash designs. And then some of my other policies are HECVs, and some of my policies are 1585s. I have all different designs. Why? Because I wanted to see which ones work. So this is just a whole bunch of policies all put together, but I have $248,430 in cash value. But if I take $63,000 out as a loan, I technically only have $185,430, but I'm earning interest on $248,000. Fair enough? So the insurance company is paying me the equivalent of just about 6%. But remember, it's been compounding now for 13 years. They're paying me interest and dividends on that. They're charging me interest on the $63,000 because the other loans I've paid back. Remember, I paid the monthly payments back to repay the loans. So let's do the math here. 13 to 17, $36,000 in deposits into the policy. My car loan payment was a little over $1,000, so $13,000 a year that I would pay back to the insurance company as a loan repayment. 65 grand. I paid 63 for the car. I pay the rest is interest, 65. Total deposits and car loan payments, 101,000 over a 5-year time frame. Minus the car purchase of 63,000 means my true net injection into my banking system for this third car is 38 grand. My cash value growth after purchasing the car is 122,354. which when we do the math, it's $3.22 back for every single dollar I paid for her car. This is the math, folks. I have done the math for you to keep it simple, but your numbers will look very much the same. There will not be much of a difference. I paid 0 interest back to the bank. I paid interest back to my bank, my private family banking system of $16,481 to buy these 3 cars right here. And all the money went back into my banking system, which means every time I made a monthly payment for any one of those cars, that money was available to me as soon as the check cleared. This is the summary of exactly how I started to learn how to do this. Just when you thought you couldn't be any dumber, you go and do something like this and totally redeem yourself. That's a funny little thing that we did. And one reason I put that on there is Dumb and Dumber is one of my favorite movies, and I just love what he says. But this is definitely what the wealthy do with money. If you really want to take this to another level, Brent Kessler did this with an airplane. I think he's done it with several airplanes. I'm just showing doing this with cars because every one of you use cars. Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action like so many others have by going to privatemoneyclub.com and sign up. Mike then said, seems like the spread is different at every carrier. I called Lafayette, their loan was 5 and their interest and dividends are 5.2. Does a 0.2% sound right? Yeah, but Mike, remember, you're getting hung up in the numbers. You're not factoring in the compound interest that I just thought I went through and explained. And I'll explain it again in another one, okay? But I want you to understand that if you just do just the math, the 5.2 minus the 5, that is your spread, okay, your gross spread in the beginning. But then every year your spread is going to change because every year you're compounding. So the next year you're compounding on a higher amount, then a higher amount, then a higher amount, then a higher amount. So your spread changes, Mike. So yes, does that sound correct? It does from the surface. But the next year that spread will be different. It will be more for you. And the next year it will be more again, and more and more and more. And listen, when you're talking about money, that word more is a pretty powerful number. It'd be cool if I could find a fill in the blanks where everything you answered was just more and more and more and more, because that's what compound interest does. It's why Albert Einstein called compound interest the 8th wonder of the world. He said, those that understand it, earn it. I just showed you how I earn it. Okay. And I showed you how you can earn it. Those that don't, pay it. And I also described in there how some people would prefer to pay it because they would say, oh, the bank's lending money at 3% and the insurance company's charging me 4 or 5. And they would go take the car loan from the bank at 3, which I just by the math showed you that that would have been a dumb decision. Don't get caught up in the traditional thinking. Understand that compound interest always beats simple interest. I showed you that. And then you will always be able to be the bank, and you'll always be able to benefit by being the one that earns the compound interest instead of paying the compound interest. Can I use this for owed back taxes? Absolutely. My gosh. I actually have a case study of this guy, Gary. This is many years old, how he used it to pay property taxes on his real estate portfolio. So could you use it for that? Certainly could. Because Robert, let me ask you a question. Actually, here, we got to do this. Robert, I'm sorry. And folks, we got enough time. I promise I'll get back to it. But here's Robert. Let's say he changes where his savings going, and the money he's saving is to pay government. So over here, he owes taxes. Okay. Now let's just say it's back taxes. Can anyone just give me a number in the chat? How much interest does the government charge you on your taxes that you haven't paid? I have it. It's over in my thing, but how much do they charge you? 12%? I think it's a lot more than 12, but let's just use 12. Okay, and if anyone else gives the numbers, let's just say the government charges you 12% on your back taxes. So let's just say you took your savings, you put them into this policy, and let's just say the policy earns between 5 and 6%. You take the money out, or you already have the money, kind of like how I showed, you pay the back taxes. So we no longer owe the back taxes. We take the amount that you were paying to the government, because at that point, most of you would be set up with a monthly repayment of that. So let's just say, I don't know the number, but let's just say it's $500 a month that you were paying the government at 12%. Then you just take the $500 a month, you recycle and recapture that money, and you pay your policy back. So remember, we took a loan here, okay, and let's just say the loan is 5%, like somebody just mentioned with Lafayette. You pay, the insurance company charges you 5%, and I want to preface this, simple interest, very, very important. You pay off the back taxes to the IRS or whoever you owe the taxes to, the state or the IRS. They were charging you 12. You make $500 a month payments back to your whole life, okay? Which let's just say your whole life is charging you 5 to 6. So forget about the 5 to 6 here. Let's do a different spread, okay? And you could do it both ways. So that one question where the person was like, 5.2 and 5%, they were doing the spread from the loan to what the insurance company pays. But let's talk about the process, and this is the process. It's a circle. Money starts in your policy in your private bank. moves over here to the opportunity. I showed you cars. Now we're doing taxes. Then after that, the money recaptures back to your private banking system. So we'll just call this private banking system. We call it BYOB. You can call it anything you want. So now let's just do the math. You were paying 12% interest to the IRS. You're paying the insurance company 5%. What's the spread? Is your spread 7%? Pretty sure it is, but it's not 7. You see, that's just I'm again tricking you guys because I'm just doing the math here. That's one spread, but then there's a second spread. So if you did that and you use that spread, then what are you making over here? I don't know, 5 to 6%. It's the combination of both. So you're technically making interest and dividends on all of the money and then the spread. I just did the spread the other way. Stephen, did that make sense how I said that?
Yeah.
You could do it either way. You could do the spread between what the insurance company charges and what the whole life pays you, or you could do the spread, which is the way I like to do it nowadays, between what you're giving away and what the insurance company is charging you. And remember in that other one where I said if the bank's charging you 3 and the insurance company is charging you 4, you wouldn't do that, but you're missing the point. You're still making interest and dividends compounding on the full amount. Like I can't make this any simpler. Hopefully that helps because that was actually a really, really good example that somebody just did. When you use your policy, do you also take advantage of the fact that you can then self-insure and only put liability on the car? Wow, Jimmy's always got the best questions and comments. And only put liability on the car and put the difference that the comprehensive would be back into the policy. I want you all to think about that.
I love it, man. I was just talking to somebody about
Holy
this
shit.
for homeowners insurance. Like, I love that right there.
I mean, think about that, folks. Like, have any of you ever called your insurance agent or gone online and looked at the difference between basic liability coverage on your car and full comp? Have you ever looked at the difference? It's thousands of dollars difference. I don't even know. It's thousands of dollars. Remember, when you're the private bank that's financing the cars, like I showed you a second ago, you don't need comprehensive. You don't need to make sure that if you wreck the car, you got an insurance. Now you might want to, but what he's saying is, have you ever looked at the difference between self-insuring? And a $20,000 car, you might want to do the math and figure out how much regular basic liability versus comp insurance would be, figure out the difference and multiply it times 5 years, and then do that times a couple of cars. How long would it take for you to self-insure that car? You're always going to need liability protection, right? In case somebody sues you or you get in an accident. I mean, you always need that. But do we always need the insurance that buys you another car or fixes your car? Maybe not. You could even then just say, well, I think if I wrecked my car, my average repair bill probably could be 15 grand. Figure out what it would take to self-insure. That's huge. And I know for a fact the wealthy do that. And Jimmy or James Davison, as you guys see him, he's always coming up with this smart stuff because he is wealthy and he works with wealthy clients and he's also a CPA. So his mind works a little different than some of ours. And he love it when he brings this stuff up because it then helps us pick up additional nickels and pennies that we might be leaving on the table. Okay, Jose said, so it would take at least 2 to 3 years to have enough cash value in the policy to be able to get a loan against it. Jose, no, when you put money into these policies, you're going to have the money available, some of the money available immediately in the first 30 days. So you can take your first loan immediately in the first 30 days. Now with a car, because it's a larger purchase, it might take a couple of years to save up the same amount. But actually, how about this? Let's do this real quick. Jose, I want to actually do the same example. So we already kind of learned about the spread. We did it with back taxes. Okay, but let me show you another way to do this. So now let's just say you're getting ready to buy a car, Jose, and I'm going to pick on you, okay? And in the chat, you can let us know. You're getting ready to buy a car and you want to pay cash. So what you've done is you've saved up $50,000 in your savings account. So you got 50 grand right now in your savings account, and you got this really sweet car. And I don't care what kind of car you want, but we'll just because that picture kind of looks like the Tesla, whatever that gull wing door looking one is. Okay, we'll just do that. Okay, let's just say that's the car you want to buy. Sorry about my drawing, but I think it's a little more rounded. Not really a Tesla guy, but there we go. Okay, there's our $50,000 Tesla. He's got 50 grand in his bank account. Now let's just say he saw this presentation. He's like, well, wait a second. I want to put my money into the policy before I buy the car so I can do the same thing. Great. So let's just say all he did is he dumps the 50 grand into the policy. We call this a dump in. And then each year, I don't know, let's just say he wants to save, I don't know, 10 grand. So he wants to save 10 grand. So we build the policy to hold the $50,000 dump in that he's immediately going to take out and buy the car. And then he wants to save 10 grand. Now, I don't care what this number is. I don't care if this number is $6,000. Whatever his number is, let's actually just leave it at 6, just for the math so you can all see. He's going to do a $50,000 dump in. Now, where'd the 50 grand come from? He just saved it. He had it in a savings account. Most of you have money saved somewhere. Okay, so he was going to buy a car with that. And then each year he wants to save $6,000 a year. I don't know why I use that number, but just whatever. That's his number. The 6 could be 16. It could be 10. It could be any number you want. So once his policy goes in force, he's got the lock on this car. So what he does immediately takes a $50,000 loan from the policy and buys the car. How much money's he got in the policy? If we're 1 year into it, let's just say, or actually, let's just say 1 month. So he had 50 grand he dumped in plus 6,000 bucks. So he had 56 grand that he put in. He took 50,000 out. Most of you would think he's got 6 grand in. He does not. He's got whatever the cash value would be on the $56,000 he put in. He's earning interest and dividends. So he buys the car for the 50 grand. This all happened within 30 days of his policy going in force. Okay, this is a 30-day window. Then what he does is he figured out what that $50,000 car would be. So let's just say that it would be, let's just do $1,000 a month. And then he makes that $1,000 a month car payment back to his policy. Same thing. He just sped up the fact. He didn't have to save up to buy the car because he'd already done that. He just changed where his savings went first. There's a lot more I want to teach you. And there's a lot more depth than just cars and showing you a couple things like this than today. So if you're really liking this and you want to join us this weekend, Friday, Saturday, Sunday, we're going to be pouring our heart out. We've got great people coming on. Okay, we're not going to just be covering stuff like this. Matter of fact, I probably won't even do the car thing. I'll do more advanced. So here's the training that we're going to be doing Friday, Saturday, Sunday for 3 days. You're going to get us. Okay. Every single, and listen, I know some of you are busy the 2nd, the 3rd, and the 4th. I know it. It's summertime. Some of you have weddings. Some of you have graduations. You guys have things going on. So for those of you that have something going on, great. Most of the people that buy this 3-day don't always attend. A lot of the people, I mean, we might sell 200 tickets for it and we might have 80 people on. Do you know why? Because they're buying for the recordings. They want the recordings because the recordings they're all edited down and timestamped. So maybe you only want to learn about like how the wealthy don't pay as much in taxes. You go to that timestamp and you can watch that training. You can watch any of the speakers from Greg Hurling to Brent Carlson talking about asset protection and self-directed IRAs. You got Matthew talking about how to get money out of your house, that lazy equity without having to do a loan, like a home equity line of credit. You got Kevin Shortell with notes, Spencer Montgomery with Bitcoin. You got Noah Harrison, one of the best there is at private lending and coaching private lending. Many of you know him. You got Mike and Mike. Okay, it's like the M&M show. They're experts in real estate. They've done everything from wholesale to big developments. They're going to teach you exactly what they've learned and how you can learn the same thing. You got Justin going to be joining us, which in a second I'll tell you what Justin does, but he's one of the partners in a private hedge fund. Those are just a few of them. So if we were to add up all the value of this, it'd be 3807.
And we've actually added speakers and there's more that are on here. So this 3 days really loaded this time. It's pretty wild.
Yeah, we got a ton of speakers. But again, like I said, you're going to get not just the ability to join us live, but you're also going to get the event recordings. But also what we're going to do is we're going to throw in not just this 3-day, the prior 3-day was epic. It was one of the best we'd ever done. So we're going to give you the recordings for the prior 3-day as well. And then we're going to give you also a discount today only. Okay. So some of you already got the discount. Yep. It's $100 off. So the tickets to this 3-day are $297, but we're going to give you a coupon code that brings it down to $197, and that's today only. Stephen, what else did we have? You had something really neat that I told them about in the beginning.
Yes, we got a limited edition BYOB Make Banking Great Again hat or shirt. We're doing a hat or shirt for this group, right?
Yep.
So the site, we're hoping to have the site up by this weekend. We have the design ready. We're just choosing between 2 different right now for this group, but it's going to be special limited edition. Nobody else will have it just for this 3-day. So it's gonna be really, really, really cool. But you guys can see my hat right now, the BYOB. But we have some really really cool new design with Make Banking Great Again on it. It's going to be super dope. So everybody that enrolls, you get the discount, the past recordings, these recordings, the consultation, and you're going to get the limited edition hat. And then we'll also throw in, if you don't already have in digital copies of mapping out the Millionaire Mystery that you see on my shelf back here, as well as the private money guide. So you can get all of that for $197. So it's kind of funny, but if you haven't enrolled already, make sure to do so right now. I'm going to throw the link
What's
in
the
there.
discount code, Stephen?
It's Summer Start. So SUMMER start, Summer Start. And I just put it in the text right
There
there.
you go. So yeah, Stephen put it up. I put it up. We were both typing them at the same time.
Oh, sorry.
Oh,
So you can
did.
register right on the site now, moneyschooltraining.com/registration. Just put discount code summer start to get $100 off and you'll be good to go.
So a bunch of you were already asking, earlier about the link and how do I sign up for the 3-day? There it is, but now you get all the goodies. And the Make Banking Great Again stuff that we're doing is freaking epic. I wish I could show it to you. I've seen it all. Probably could find it on my phone, but it's purely epic stuff. And you'll be the only one with it, because how we did it is each one of these previews, we did a special offer. Like the first one, we gave away skateboard decks, limited edition numbered skateboard decks. It said BYOB. The one Stephen did the other day, they gave away one of those limited edition hoodies that's different than the one you're going to be able to get here. So each one of these little previews, the people that registered, like if they saw somebody at one of our live events, like the Money Tank event coming up in August, and they had the Make Banking Great Again shirt, they'd be like, oh, wait, I was on that same one. You two are the only two, and then maybe a handful of others that have those. So folks, don't delay on that. Get your registration done now.
So if you don't mind, when you're doing this, just when you click on enroll, it takes you to this page right here. And then up here at the top is where you put in that summer start and apply that. That'll add the discount down below. And then, so you see it takes it $100 off to $197. And then if you don't mind, in this notes section right here, just put a hat if you want a hat, or if you want the t-shirt, put the size medium or whatever, just so we know the proper one to send you guys. So we will give you a choice between the hat or the t-shirt. So that's what's left for this group. And then that'll end today. Anybody else that enrolls before Friday will get the discount, but not this bonus merch. So make sure you go on right now and register, because we do have our helper Rod. She's tracking it right now. So only orders that are coming through now are going to get that limited edition merch. So just make sure you put that in right there and get it done right now.
That's really important, because a lot of people will see this and then they're like, oh, I got to go check. I got to ask my husband. I got to ask my wife. And then when you come back tomorrow to do it, you're not getting that limited edition thing. So, because Raj isn't going to sit there 24/7 waiting for people to make the decision. The time is now if you want that free limited edition shirt. If you just want to join and you don't care about the shirt or the hat that you're going to get, that's fine. You can register tomorrow. The next day you can register Friday morning if you want. But the best way to do it would be to do it right here and right now. All right. So let's see. Let's keep going. One thing I wanted to do before we did that, I wanted to just show you how I figure out the monthly payments on cars. You don't have to put bank rate. Even if you didn't put that, you'd get car loan interest calculators. So just car loan calculator. I put bank rate because it's the one I've just gotten comfortable using. And I come in here and I can figure out what a car loan is going to be. So let's just say you're buying a $75,000 car, 60 months, vehicles used, the interest rate, and you could actually compare loan rates. So you could see what the best rates are. So you could click here, and I'm sure I'm going to get an email or two, but you can see what the different loan rates are. Holy crap. Is that how much loan rates are right now? Dude, you guys got to be kidding me. Like, what if I got excellent credit score right there? Holy smoke. Steven, did you know the car loans were that much right now?
I knew they were around like 5, 6, 7. I didn't know they were up above 8.
I didn't know they were that high. So anyway, yeah, let's just say you wanted to, I don't know, you could put your interest rate, you're the banks, you can put your interest rate anywhere you want, but I always tell people, put your interest rate where your payment's going to be with somebody else. I mean, that makes sense. So 8%. So here's another thing too, and I want to do this really quick. So this would be the auto loan calculator. You can use this for simple interest, compound interest, but I want to show you another one. So lease calculator, lease payment calculator, because I promised that I would show you guys how to do this. So right here, so you can see here, there's how to calculate a lease payment. Because your question was, what if the client doesn't want to buy the car cash? They want to lease the car for the business. So Mike, can you give me some inputs for the potential car you'd want to lease? Like, what do you think the car would cost? Like, just give me some specifics on your perfect lease that you would want to do for your business. So I don't want to use my numbers, Mike. I want to use yours. And you can just do it right in the chat. Okay, you're looking for $1,000 a month? What kind of car are you going to get? I mean, like, do you know how much the car is going to be? Because we got to put an MSRP in there. I can reverse engineer it for 1,000, but I'm just trying to save time, Mike. So $1,000 a month, maybe, I don't know, that'd be what, like a $60,000 car? 110. All right. So there we go. 110,000 for $1,000 a month. Mike, I don't know, but I don't think you're going to lease a $110,000 car for $1,000. Maybe if we go out further with the lease, but let's just push it out to 36 months and see where we're at. All right, final negotiation price. Let's just do 110. There we go. Residual. I don't know. Let's say car values are going to hold. Let's say it's going to
Car loans have not quite gotten to where boat loans are. They're pushing boat loans at 25 years now.
yeah. So Mike, if you lease the car for 36 months, your payment would be $1,656. You still good with that? I mean, that's about what a 110. I mean, you can get well, you get a lot of nice cars for 110 grand. Yeah, so let's just go with this, all right? And then what we're going to do is we're going to lease a vehicle. So it's going to be about $1,656 a month. Okay, that's going to be our lease arrangement. It's going to be for 36 months. And it's basically essentially $110,000 automobile. Does anyone want to, what kind of car costs $110,000? Like, anyone want to pick a nice, cool car? While we're doing that, I want you to look over here. There's one thing most people that lease cars don't understand is in a lease, there is a baked in interest rate. So right here, we're just putting 4.5, but I can tell you just because I know where to look for this, it's higher than that. It's usually 7-8%. And if you've ever read or kind of watched any videos on how to negotiate a lease, they call this the factoring rate. You negotiate the factoring rate that the leasing company does. There's not much you can negotiate on a lease, but you certainly can negotiate the rate, which is right here. So I'm just going to leave this at 4.5% because I don't want to drive this monthly payment up any higher. But right here, so you can see we've got a $110,000 vehicle that we're going to lease. We're not going to put any money down. Anyone that leases a car, please don't put money down on the car. So we actually got to change that, 1688. Okay, it just makes no sense to put money down on a lease. All right, so 1688. Lending rate is 4.5. They call that the factoring rate. So there we go. So now that you guys have that, here's how I did something very similar. I did it with a G-Wagon. It was a used one. It didn't cost me $110,000. I got a good deal on it. If you were going to lease a vehicle, what are the reasons you would lease a vehicle? Tax deductions. It's almost the number one reason people do it, because you get a tax deduction on the vehicle. So if it's used for business, which I think Mike wanted to talk about it for business because he said, for business use. So if you're using your vehicle for business solely, this lease can be a write-off. Now you got to be very careful. You got to have a lot of tracking, have a good bookkeeper, have somebody really making sure that this is being used for the proper things. $1,688 a month for 36 months. The other reason people would probably do a lease over a purchase is $110,000 loan would be way more than $1,688. It'd probably be closer to $2,000 bucks. Okay, so it's a savings in monthly payment. We got a $110,000 car that we're going to lease for $1,688. Now, could you go and lease the vehicle from the dealership? Yes, but how much would you be giving away? Let's see. You'd be giving away, well, all the monthly payments that you make, but the interest too, which for some reason this calculator isn't showing me what that is, plus the leasing fees, the depreciation fee of $1,200 bucks. I'm just trying to call out, like, leasing seems cheaper, but it's actually one of the most expensive ways. It's just, we've been so conditioned to think of a monthly payment as whether it's cheap or expensive, but that's not it. It's what you actually get at the end. Cost, write this down, folks. Cost is only an issue in the absence of value. Cost is only an issue in the absence of value. For $197 to come to this 3-day event, I promise you will get tons and tons of value. So the cost is only an issue in the absence of value. So in a lease, the cost is only an issue in the absence of value. Well, where's the value in the lease? Just the tax deductibility. That's really the only value that you're getting, because everything else is irrelevant. So here's how I do it. You just saw how I buy cars, right? I put money in the policy, I take a loan from the policy, and I buy the vehicle. So real quick, I'm just going to do another calculator here. And what I'm going to do is I'm going to figure out what a $110,000 car payment would be over 60 months. And I'm just going to do an interest rate of 6%. I'm going to give myself a deal.
Yeah, Joe. So the entire time we'll be asking, answering questions. The chat is on, the Q&A is on. All the speakers leave time to answer questions and interact with everybody that's on virtually. So absolutely, it's very interactive. Chris and I will be on the entire weekend. We have some of our money mentors on standby, even if you wanted to, hop on a phone right then with them. So we'll be right there with you. So
if I wanted to buy a $110,000 car, I would save up $110,000 in my policy, okay, or 120 or whatever it would work out to be, so that I could use 110. So probably let's just do 115,000, and I would take a loan for 110K. and then I would buy the car. All right, so 110. So you guys all see what I'm doing. So I'm taking the loan from the policy, I'm buying the car. But then what I'm going to do with that car is I'm going to figure out what my monthly payment would be, because I can't use bankrate.com. I'm going to round it up and say it's $2,000 a month. But I don't want to pay that. And I want to lease a vehicle because I'm going to use this vehicle for business. So what I'm going to do is I'm then going to go to my attorney, and I'm going to have my attorney draft a lease agreement from me personally. Why me personally? Because I own the car now. I bought it with my policy. I'm going to lease the car from me to my company. So let's just say this is my company, and I'm going to charge my company the exact same amount anyone else would have leased that vehicle. I did this for a gentleman. We did all the mathematics for it. And you know what he did? He still leased the vehicle from the dealership because it was easier for him. That's the part I'll never understand. Like, there's the easy way, and then there's this way. This way is not the easy way, but this is the best way. And he still went to the place because he said it was easier. Actually, it was because he wanted the car right then. So anyway, don't be that guy. So now I'm going to have my company issue a monthly payment of $16.88 every single month back to myself. And then I'm going to take that $16.88 and I'm going to put it back into my policy. See what I did? First, I bought the car using the policy, which would have been $2,000 a month. Then I leased the car to my company, fully legal. Make sure you have your attorney structure the paperwork properly. Make sure you do your proper bookkeeping to make sure the vehicle is used for business. And I make monthly payments of $16.88 from my company back to me. Now, is that a tax write-off to my company? 100%. Is it taxable to me? 100%. This weekend in the 3-day training, we're going to basically have a guy, his name's JP, come on and show you how it wouldn't matter that this $16.88 is taxable, because it's a complex trust structure. So I want you all to understand, and Jimmy knows what I'm talking about. I know, right? And I did a video on this. It went 11 million views on Instagram, and everybody's like, it's not a benefit to you because you get a tax deduction from your company because you got to pay tax over here. I'm like, oh, I wish you folks only knew what I knew. I wish you'd get around the campfire, but you all are. So whether it's a tax write-off or not a tax write-off, let's just say there's no tax benefit. Let's do the math here, because this is the best part about it. $110,000 car. What does a Tesla Plaid cost? Yeah, $108,000. All right, so this is now a Tesla Plaid. I just need to know a car, what it is, because I need to know the residual value. So we haven't figured that out. Now, let's just say you do this, and you've been driving this vehicle the whole time. You're getting paid. Technically, you are getting paid because that money's paying your policy back, which means every month, $1,688 is available in your policy. Every monthly payment your company makes back to you. But see, after 3 years, what you're going to do is you're going to give the car back. You're going to give the Tesla back. So what I got to look at is I'm going to look at a used Tesla Plaid. Here we go. So 21, 22. So I need it. Let's do the cheapest one. 89,000 bucks. You're not going to touch one of these used for any less than 89. So let's just do $89,000. Okay. So now this $110,000 vehicle that my policy bought was leased to my company for 3 years. The company paid back $16.88 a month. So let's just do the math. $16.88 times 12. So the company every year paid back $20,256, and that was times 3 years. So it was a total of $60,768. Did I do my math right? 1688 times 12 times 3. Yep. So this is how much money was paid back of the $110,000 I paid for the car. If all of you have been tracking with me, I just told you that a Tesla Plaid, the oldest one, is 89,000 bucks. So if I sell this car for 89,000 bucks, plus I got PAC, my company paid me 60,768 before taxes, 149,768. Okay. So 149 is how much I got. That's how much I made, but I had to pay 110,000 for the car. So I technically made $39,000, 39,768. So this is how much I made, 39,768. But I know that on this training right now, there's someone on here that's like, no, you didn't. You had to pay taxes. Great. So let's take off 30%. You made minus 30% taxes. You made $27,837 net of taxes. Everybody tracking? Divide that over 3 years. So every single year, You got paid $9,279 after taxes for driving a Tesla Plaid. I don't know what else to say. I don't care what kind of car we do this on. If it's not a Tesla Plaid, it's a G-Wagon. If it's not a G-Wagon, it's a GMC 2500 diesel. It doesn't matter how we pencil this. The reason that car manufacturers want you to lease cars is because this, okay? They might not be using the policy, or maybe they are, but you see, folks, I'm trying to teach you how to be the bank and how to take back control of your money. If the car manufacturers and the finance companies want you to lease, there's a reason. It's because they're making money. And you can change the dynamic of all of this, and you can take back control, and you can make all the money instead of them making all the money. I just showed you and we just did this together. I didn't have any of these numbers. That's why I was stumbling. That's why I had to go on and try to find things. I didn't know these numbers. The numbers are the numbers. Do them however you want. This example could be not a $110,000 car. It could be a $50,000 car. It could be a $20,000 vehicle. It doesn't matter. It's always going to work because it always works for the finance companies. Therefore, when you become your own banking system, it will always work for you. And then you get with someone like Jimmy, or you get with someone like Tess, or you get with someone like our fractional CFO, who's going to be on this weekend, and you learn how to do all the tax side of this, and you learn and do the math to figure out, does it make sense for me to self-insure? And then you find out, wow, that's extra money I made. You see where this doesn't end. And all we did today is cars. Like, what if I showed you like what Sam was talking about in college and medical expenses and baby deliveries? But I'm out of time. I apologize, Sam, but I will this weekend. I'll hit that stuff. It never stops, folks. This isn't some magic like potion thing. This isn't something that like only works for some and not others. This works for every one of you. So why would you not join us this weekend for the 3-day training? And I already said, if you already have something planned, you get the recordings. They're time-stamped. Every timestamp will tell you what that part of the training was, and you could just dial into just that. Cost is only an issue in the absence of value. If before right now, if you paid $197 to learn this and you were getting ready to lease a car, was that worth your $197? Cost is only an issue in the absence of value. Just this alone would be worth $9,279 a year to you. And even if all you did was paid $197 just to watch this one timestamp of a 3-day training, how much value did you get? Do I need to do the math? I think you understand. I'm not trying to sell you a 3-day training, folks. I'm telling you, you'd be stupid not to join us this weekend, whether or not you can actually attend or just get the trainings. And then you get a really cool hoodie that, you know, if it said Supreme on it, would cost you more than $197 anyway. Sorry, I can't give you the Supreme.
Is that like a Supreme pizza? What's Supreme?
Supreme, it's a brand out of New York City. It's like a skateboard kind of brand that went crazy, and their stuff is crazy. Just look it up. Just type in Supreme hoodie.
Will this work for someone who is retired?
Of course it will. Always works for someone that
I'd be willing to say it's more important for somebody to retire because you don't have time for your money to come back. You don't have time to make the mistakes. Like, you need to learn now or good luck, you know?
There you go, Steven. Supreme hoodie, basic white Supreme hoodie, $400.
I could get our merch guy to make some of those.
Just saying, cost is only an issue in the absence of value.
We'll put Supreme with BYOB right below it. How about that?
Oh, just messing with you. Let's
That's
see.
Wild.
Jose said, so it would take at least 2 to 3 years to have enough cash in the policy if you funded it monthly or just annually. But like I showed you, if you did the dump in, it would get you more.
Would IRS section 179 change anything about the illustration?
Yeah, I mean, the section 179, just so all of you know, it's a bonus depreciation. You get to depreciate the whole vehicle. You can do this with equipment, airplanes, and things of that nature. There's 168. Jimmy's got to bail me out here because I'm not a CPA and I'm not giving you tax advice, but there's the bonus 179 and then there's also a 168K. One of them went away this year and I'm not sure which one it was, but you guys can look that up yourself or consult with a good CPA like Jimmy, or you know, you got Tess who could probably figure that out pretty quickly, or our fractional CFO. It would definitely help a lot because then on top of what I just showed you over here, you'd also get to depreciate the whole darn vehicle. So, I mean, that wouldn't suck, right? So you take a $110,000 vehicle and you're able to depreciate it all in 1 year, if that is still available. And again, I don't know if that was like a really awesome thing that a lot of people took advantage of, but I want to say that it got squashed with this administration, if I'm not mistaken. Did I really, either I really sucked today or I did such a good job explaining the details over the last hour and a half that no one has any questions. So hopefully it's the latter of the two. But anyway, folks, not to take any more time, I appreciate each and every single one of your, oh, hold on. This is epic. Dustin came in with a final second question. Can I Turo that car out? Oh boy, do I got something for you. Folks, I'm going to share with you something that I did 2 years ago now. It's crazy. But I've got a guy, Jason, who actually does this, but he does Turo. Okay. And he rents his cars out. And the one we talk about, we're in California doing this. I love that I can always say, like, wait a second, I got a video on that. Dustin, this video is freaking epic. And this is our friend Jason. That Lamborghini behind us in this video is his Turo. Now he's got a whole bunch of vehicles that he Turos, but in this one, I explained exactly what I just did here, but I explained then using the Turo with the IBC concept that I just taught you and what that looks like. The numbers are silly. So believe me, folks, you might, after watching Jason's video, this case study we did, say that sounds too good to be true, but I'm really glad you put that question in there because it's pretty epic. So I put that video in there, folks, copy and paste it. Even if you just watch it, it's fun.
Here's the latest car he's using.
Oh yeah, the McLaren. Yeah, that one's a Turo as well. So, you know, we go from a Lamborghini. Actually, I think somebody wrecked his Lamborghini. So then he upgraded to the McLaren.
Oh, okay. That was a sweet ride though.
So folks, this is a ton of fun. Thank you all for joining us. Please take advantage of this weekend and what we're doing and the discount offers and all the cool stuff that we just threw in there. I'll put the link one more time for anybody that did not get it. Get your tickets now because tomorrow you're not going to get that limited edition shirt. And with that being said, I'll see you guys at 4:30 today for the Ask Me Anything happy hour. Matter of fact, we will see you this afternoon. Thanks. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.